This is Nick Rach with the Earnings Scout, and I'm going to update fourth quarter 2016 earnings estimate revisions here in third quarter earnings season, which to us is the most important thing of third quarter earnings. But want to talk about late reporters and how they become weaker here as what we measured last week. I want to explain that by showing you through October 28th, prior to last week, 289 companies in the S&P 500 had reported their third quarter results. And what you could see here on the earnings front, 73% of them were beating their earnings estimates on about 6.29% growth. 58% of them were beating their sales estimates on about 1.28% growth. Now, if we look at last week, 135 companies reported last week, and this is from October 31st to Friday, November 4th. And what we've seen here on this front is only 67% of them were beating estimates, so a lower number than the 73% on 1.79% earnings growth. And here's something that sticks out to us even more. Only 44% of companies reporting earnings last week beat their top line sales estimates on 0.3% growth. So what we're seeing here is less beats last week, especially on the top line, and we saw weaker growth last week from companies that were reporting. This isn't too atypical in earnings season. The late reporters tend to report weaker results. We also had some more energy companies in there. But nevertheless, the beat rates and the growth rates have come down throughout earnings season. And what's even more important to us, though, is the guidance the companies were providing last week began to weaken. And what we want to show you is over the past year, the rate of change to S&P 500 earnings expectations. This is over the past 4 quarters. The red line here is just simply the price of the S&P 500. You can see how it's come down here since really the end of August, early September. The S&P has been drifting lower. But what we want to show you here is this blue line where we measure an earnings score. The earnings score is measuring the overall expected profitability for all the aggregated S&P 500 constituents, and we aggregate this data up. If we get an earnings score that is negative, that says on an absolute basis the earnings estimates overall, multiple quarters, multiple years of estimates for the S&P 500 are going lower. The score itself will tell you the magnitude by which they're going down, and the key to us is that magnitude. So if we go back to third quarter 2015 peak earnings season, 1 year ago today, estimates overall expected profitability for S&P 500 companies were falling by a rate of minus 2.75%. And then in peak fourth quarter earnings season, so you're going to be talking here mid to late February of 2016, estimates were coming down at an increasing rate of minus 3.98%. Then in first quarter earnings season, what we saw after the ECB increased stimulus and the Fed decided no longer to raise interest rates in March, we saw estimates come down in the first quarter after companies reported results. However, they were coming down by a rate of minus 1.54%. And then in second quarter earnings season this past summer, estimates were coming down by a rate of minus 1.32%. Over this past week, though, we saw a deterioration in the earnings revision trends. And now here in peak third quarter earnings season, we're seeing estimates begin to deteriorate and fall at an increasing rate over last earnings season. So if we draw in the trends here, and this is the trend that's so important to us, when estimates are falling at increasing rates, stock prices go down. That's what was exactly happening at the beginning of this year in 2016 and why stocks struggled so poorly out of the gate in 2016. And then as estimate revision trends improved, and we say improved, that does not mean they're going up. We have negative earnings scores. What we mean is the estimates are being cut at lesser rates. This is the positive delta. When you have positive delta to the EPS estimate revisions, positive stock prices. But now as they're beginning to roll over a little bit here, you're seeing stocks start to struggle again. Stock prices do not follow the absolute changes to earnings estimates. Stock prices follow the direction or the delta to the earnings expectations. This is key. This is the right way to look at earnings estimate revisions. But I want to show you the future growth expectations, where we're at. In 2015, we had all this weak to negative growth. We actually say there was slightly positive earnings growth in 2015. Some other data service providers were saying that was all negative. It doesn't matter. It was weak and negative. But the one thing that is going on here in 2016 is growth is accelerating in 2016. This is actual growth here now too. And what we want to say is the third quarter growth rate is going to be better than second quarter growth rate, which was better than the first quarter of 16 growth. And we can take it to the bank that fourth quarter growth is going to be even better than the third quarter growth. We're not going to know that fourth quarter growth until mid to late January and early February. However, that has been priced into stocks. That's why the big reason why stocks did so well from February to September. What we are concerned with is right here, the high expectations for the first quarter of 17. Look at that 11.84%. It is too high. So what we're saying in the weeks and months ahead, a year ago, we had relatively low hurdles for corporate America to clear on the earnings front. In the weeks and months ahead, much higher hurdle rates. You had 11.84% expected growth for the first quarter of 17. As such, this improvement in earnings trends that we were beginning to measure from March through September, it's rolling over now. We think with the 11.84% first quarter 17 growth estimate, when companies begin to report their fourth quarter numbers in December, January, and February, what we're going to see is continued downward trend in the earnings estimate revision trends through the end of the year. That is something that we're forecasting. And no matter who is president, we know futures are spiking this morning on the FBI clearing Hillary Clinton and the market liking Hillary Clinton. But here's what we're saying. No matter who's elected this week, president, and it's looking like Hillary is going to be elected, but if Trump pulls off the surprise, no matter who is the next president, it doesn't take away the fact that the expectations over the weeks and months ahead are much higher for corporations to clear. And you have a Fed that's going to tighten, most likely in December, and the potential of an ECB tapering back on its QE bond buying program. And we could very well have a replay of what we saw at the end of last year, early 2016, where the deltas to earnings expectations weakened and turned south and prices struggled. So our normal allocation to stocks right now that we upgraded from a bearish view back in March of 2016 when we became neutral on stocks in 2016, allowing our clients to participate in the rally. We now have that under review because we think the deltas to the earnings expectations are going to continue to weaken in the weeks and months ahead. So if you have any questions about what we're analyzing on a macro level, you can contact our sales and marketing team at the numbers below, or contact us at sales@earningsscout.com as well. We also do individual company analysis because we aggregate all this data. We'll be happy to do custom portfolio analysis for you as well on a complimentary basis as you check out our research. So thank you for your time. Have a great trading week, and we'll be back next week. Thank you. Bye.